Hello everyone, under this video you're going to see how to treat the cost of improvement and also how to use the fair market value. Now let's look at the problem. It says that Mr. X had acquired a building for rupees 5 lakhs on 1/1/1995. Then Mr. X had built two additional floors, one on 1/1/1999 at a cost of 25,000 and the other on 1/1/2004 at a cost of rupees 40,000. Then he had also incurred expenses on repairing the building on 1/10/2010 of rupees 10,000. The building is sold on 1/1/2020 for rupees 30 lakhs and there is a selling expenses of rupees 15,000 in which you have to determine the capital gains assuming the fair market value as on 1/4/2001 is rupees 3 lakhs. Now before solving we have to see first of all whether this asset which has been transferred is a long-term capital assets or a short-term capital assets. Now if the assets here, it is a building, then it has been purchased on 1/1/1995, it has been sold off on 1/1/2020. So in case of a building, if the period of holding is more than 24 months, then it will be taken as a long-term capital asset. So in this case the period of holding is more than 24 months. So this building which has been transferred here is a long-term capital assets. Now let us look at the improvement. So now here in this case Mr. X has built two additional floors, one on 1/1/1999 and the other one on 1/1/2004. So regarding the improvement, you have to note it down that any improvement which is being made prior to 1/4/2001 will not be taken into consideration. So in this case there's an improvement on 1/1/1999. So this improvement which is before 1/4/2001 will have to be ignored. Then there's another improvement on 1/1/2004 at a cost of 40,000. So this improvement is after 1/4/2001. So this will be taken into consideration. Then he has also incurred expenses on repairing the building which is of rupees 10,000. So since this is not a capital expenditure, it will not be taken into consideration. Then the building is sold off for rupees 30 lakhs. Okay, now let us look at the solution. So first of all, you have to see what is the full value of consideration, that is the sales value. So the building has been sold off for rupees 30 lakhs, so the full value of consideration will be 30 lakhs. Then you have to less the expenses of transfer. So in this case the expenses of transfer is rupees 15,000. Then since it is a long-term capital assets, indexation has to be done. So before doing the indexation, let us see what is the cost of acquisition in this case. So now you have to remember that this building here has been acquired on 1/1/1995. So according to section 55 2B and C of the Income Tax Act, if any property was purchased or acquired before 1/4/2001, then the cost of acquisition will be the fair market value or the actual cost, whichever is higher. So in this case the building has been acquired on 1/1/1995, that is, it has been acquired before 1/4/2001. So if it has been acquired before 1/4/2001, then the cost of acquisition will be the fair market value or the actual cost, whichever is higher. So the actual cost here is rupees 5 lakhs and the fair market value is rupees 3 lakhs. So the actual cost is higher, so we'll take the cost of acquisition at rupees 5 lakhs. So then after that you have to do the indexations, and indexation in this case will be the cost of inflation index of the current previous year, then divided by the cost of inflation index of the year 2001-2002. So the cost of inflation index of the current previous year in this case is 289 and the cost of inflation index of the year 2001-2002 is 100. So after calculating you'll get 14,45,000 as the index cost of acquisition. Then from the full value of consideration you have to also less the index cost of improvement. So let me repeat again here. There are two improvements. One is on 1/1/1999 and there's another improvement on 1/1/2004. So any improvement prior to 1/4/2001 will be ignored. So in this case we'll take only the improvement which has been made after 1/4/2001. So in this case the improvement has been made on 1/1/2004, that is at a cost of rupees 40,000. So since it is a long-term capital assets, then indexation has to be done. So 40,000 then into the cost of inflation index of the current previous year, that is 289, then divided by the cost of inflation index of the year in which improvement has been made. So improvement has been made in the year 2003-2004. So the cost of inflation index of the year 2003-2004 is 109. So after calculating we get 1,06,055 rupees. Then from the full value of consideration, if you deduct the expense of a transfer, the index cost of acquisition and index cost of improvement, you will have the long-term capital gain which is 14,33,945.